This is Special Focus right on Equity Access, your daily insight on stock market developments and on the Zimbabwean economy. A beautiful evening it is to you. I'm Ibn Mabunda. Let's roll. On agenda tonight, Nampak Zimbabwe, a listed packaging materials manufacturer on the Zimbabwe Stock Exchange, today held an annual general meeting in the capital in which a quarterly report for the first quarter to 31 December 2018 was released. Group CEO Van Gent did highlight a 13% growth in terms of revenue. Nonetheless, he highlighted the effect of inflation in that figure in question. At the same time, the managing director lamented the effect of forex shortages in the country. While the group is exporting certain of its materials to Malawi as well as to DRC, aiming for a 30% increase in terms of their export figures. However, maintaining the issue to do with forex, he also highlighted that parent company Nampak South Africa has highlighted that they will no longer be assisting the group in as far as forex is concerned until they're able to pay their creditors in as far as that is concerned. At the same time, the group also did highlight that they have to import goods worth $3.5 million per month in order to stay in business. Now, given that quagmire, they find themselves in a conflicted position. Of note, of course, is the fact that the group has 3 units which are Hunyani, CMB, as well as Megapack, heavily invested in the manufacture of packaging material for plastics, cans, paper, as well as the processing of timber. Elsewhere, Mikos Limited Group, a listed company on the Zimbabwe Stock Exchange, today issued a statement on the ZSE to the effect that they have put to bed a pending issue with a creditor. Backdrop is in 2013, Mikos engaged a company known as Wide Free Investments, trading as Core Solutions, towards the recovery of an amount owed to Mikos Limited by the Reserve Bank of Zimbabwe. Now, the part of the deal was as Core Solutions engaged in its dealings, there would be a payment of $1.4 million. That did not happen, and the deal turned sour. Well, one thing led to another and another and another. Eventually, Core Solutions attached the assets of Mikos Limited in that regard. Early this year, Core Solutions auctioned goods worth over $100 million for just $2.7 million. That being, of course, Mikos Hospitality, which houses Mikos Hotel, Vic Falls, as well as Mento Africa, which owns Cape Grace Hotel, which, of course, did not augur well with the group. Eventually, they appealed against that. As a result, we have come to this point where they have said they have had a seeming out-of-court settlement with their creditor, and the issue has been put to bed. Also, Zim's largest milk and dairy products producer, Dairy Board, today held a familiarization tour with Parliamentary Committee on Industry and Commerce, where the CEO, Anthony Mandiwanza, highlighted issues to do with dairy produce in Zimbabwe. He did release statistics that are a bit worrying, advocating for government to chip in and bring in solutions that can alleviate the situation. Situation is Zimbabwe demands 120 million liters of milk annually. We are currently producing just 70 million, so that means we have a deficit of 50 million. To address the deficit, Zimbabwe has to import dairy products worth $7 million, $2 million being, of course, imported by Dairy Board. Well, the bad side of the stats is at our peak, we were able to manufacture about $260 million. That was 1990 to 1991. And also our herd in terms of dairy has plummeted from 192,000 to just 32,000. That's why, of course, the CEO, Anthony Mandiwanza, did call upon government to chip in and come up with strategies that boost dairy production in the country. Well, what we're also getting this late this afternoon are some figures from the Reserve Bank of Zimbabwe in as far as the month of November monetary supply is concerned. For conversation on these and other issues, I'm joined in studio by our resident chief analyst, Respect Gwenzi. Respect, good evening and welcome to the show.
It's always my pleasure. Thank you.
Beautiful. Let's cut to the chase. Well, today, Nampak, of course, held an annual general meeting. They released, of course, a quarterly report for the first quarter to 31 December 2018. They also did spell out that there has been a strengthening growth in terms of revenue. So what is the significance of this given the fact that they have recorded 13% growth in that regard?
That's a good performance, but I think before we get deep into discussing the numbers, I would like to share a comment by the CE before he presented those results, which is of quite significance in terms of where the company is going and where it's coming from and the operating environment.
Go ahead.
In his statement, he said, "This year I stand here, none the wiser, as there is very little to suggest an improved social economic environment in Zimbabwe." The significance of this statement is that between last year and this year, there has been less in terms of an improvement on the macroeconomic environment. In fact, things have gotten worse. That's what he was trying to say. The challenges that they highlighted in the prior year were to do with forex unavailability. They have always demanded something which the country has not been able to provide. I mean, the Arabs that has not been able to provide their monthly demand. It has also not been able to remit some of the money that's due to outside creditors.
Okay.
And most importantly, Nampak, South Africa, which is the company's parent. And now coming to the performance, when you look at how how the overall group performed in the first 3 months of the year, you can see that there was inflationary pressure which impacted growth of the top line. Because we said top line is a function of two things, which is your price and your volumes. Okay. They couldn't really specify what percentage was impacted by inflation. But okay, we know that in the last 3 months of the year, inflation went up all the way to about 42%.
Right.
And they only recorded a growth of 13%. And that really tells you something to do with volumes coming down. I believe that the volumes on the net were off compared to the same first 3 months of the year. Okay. Why? Because the level at which prices were increased was far much higher, but rather volumes came off. And why would I say volumes came off? Because at Megapark, demand is up, but then supply is low. At the third unit, which produces metal packaging material, it has also been down. Okay. So you can really deduce that volumes were down, but rather price went up. And on the net, we saw that marginal improvement in terms of the overall revenue. But I believe that the group's performance lags the current inflation pressure or the inflation rate that we are incurring.
Okay, and what can you expect going forward in as far as the performance of the group? I mean, are there any strategies in place that perhaps they could, pull out of the bag and, get themselves back on track?
If we are to go by the half year, by the full year group presentation from the SA parent, the company said from their Zim unit, they are no longer allowing non-cash payments for those who want them to supply their raw materials. So most of those companies which are now dealing with Hunyani have to pay forex upfront, not the RBZ. So that's that's more of a hedging position in terms of their Zimbabwean operation. So I think that may help their cash positions, but overall, the demand that the company has of 3.5 million per month is something that the RBZ has not been able to match up, and therefore there's likely to be a sustained failure to meet the raw materials demand that the company has. So I see a sustained problem in terms of the operation and managing to meet the current demand.
Okay. The CE did highlight that they have strengthening demand in Malawi as well as DRC. aiming for a 30% growth in that regard. What do you think would be the significance of that, given the complexity that the company finds itself in?
Yeah, it could stem a bit in terms of forex cash flows, but when you really look at the nature of the businesses that they do sell, or that the kind of products that they do export, some of them are low margin products. Those bottle top, what you call bottle tops.
Okay.
Those are the kind of the stuff that they import, that they export. Among other, in Malawi they export the material for tobacco packaging.
Right.
But overall, I don't feel that at profit level they generate enough to counter their local demand. Because if you look at an almost 80% market, I mean, when you split their revenue in terms of the region and local, you see that 80% of their market is in Zimbabwe. And therefore, the 20% in terms of net profit from outside cannot compensate for what Zimbabwe demands, which is that 3.5. And they've said they've tried to engage RBZ, but RBZ is not availing those funds. If you want to look at how drastic the situation is, if you look at Delta, which is one of their largest clients and a giant in the beverage space, I mean, having a market share of over 70%, they are failing to supply sparkling beverages. They're also failing to supply canned drinks. That shows you the gravity of the problem that that Hunyani has. Besides, they really have got a big leg in the tobacco space, and tobacco is coming just around the corner. But now, if they are not able to secure the forex, or if they are not able to pin the customer so that they avail the forex upfront, then they might see a sustained decline in terms of volumes. But tobacco is a USD crop. They might be able to stitch a deal with the client, same as other companies which operate in that space.
Okay. Progressing, Miko's Limited, they issuing a statement today to the effect that they've been able to put to bed a pending issue with a creditor whose core solutions, a positive in that regard. What are your thoughts where that is concerned?
Yeah, that's something which is welcome, and definitely brings a finality to what investors have always been fearing, that maybe assets are being stripped, and maybe there's been some real corporate governance, lack of observance of corporate governance issues. So I think it's a good thing, but I also want to highlight that if there was an outside court agreement, which is what happened, we don't know the extent to which Miko's had to give in, because previously they were refusing to put on the table that 1.4. It accrued interest, it went over to over 2 million, and still they resisted paying that. And once they saw that the third party, which is Core Solutions was not a creditor per se, it was a person who provided, it's an entity which provided consultancy service with regards to an outstanding RBZ amount.
Right.
So what happened now, when we are told that there has been an amicable solution outside the court, we also have to verify the depth at which they had to give in terms of the amount that they finally had to pay. Because when you look at what they could have paid 2 years ago when they were due to pay, and what they finally paid now, you might see a big variance, and the company might have lost in a way. But all the same, the loss might be better off than losing a significant amount if they would have lost control of the company.
Yeah, I mean, I would agree with you there that this is very much of a positive. Looking at the fact that, well, these they're assets that are worth over $100 million. We're talking about Vic Falls, we're talking about Miko's hotels, as well as their investment in Mento Africa, which houses Cape Hotel in Cape Town. I think this would definitely serve as a positive and perhaps lessen the burden, because if you recall, we attended an annual general meeting where where there were a whole lot of issues
Sure.
that did not augur well with the investors in the company. So I think that's very much of a positive. However,
but I also think that there is still some corporate governance deficiencies in Micos.
Okay.
I believe that a whole lot of decisions are centralized around Moxon and obviously his close associates, which I don't think is good for business. I believe some of these issues, if they would have been deliberated across all the interested parties, the minority shareholders, of course there's a board, but then we know that the board is not rightly composed. It's mainly a group of hand-picked Moxon's colleagues, so definitely it's ineffective. But if there was a collective approach to management at Micos, then we would have had sound decisions. The same loss that the company incurred on the Cape Grace issues, the same way that the company lost on the RBZ issues, the same way that they are now losing on this case. It just shows you a myriad of problems that that point to one man making decisions which may prove costly for everyone else at last. So I think it's a real case that has to be brought back to the fore. I know 10 years ago, with regards to the Kingdom Micos major, same issue where Moxon exerts influence over the board, have shenanigans in terms of how he manages funds, how he manages those foreign investments. I think it's high time Micos has to get back to observing just simple corporate governance principles.
Yeah, of particular interest as well at their previous AGM, Eddie Cross, a minor shareholder, coming in there to say, look, we invested $20 million in Mentor Africa, and for a 35% stake. We have no shareholding in Mentor Africa. We have no influence over the company. In addition to that, there has not been any form of dividends back to the Micos Group, and that being a concern that the shareholders were advocating for that issue to actually get to be resolved. So I think these are issues that the group needs to look at and look to solve as they pave a way forward. But a positive in that regard that they've been able to put to bed this particular issue in this context. Moving on. Zim's largest milk and dairy producer, Dairy Board, today held a familiarization tour with Parliamentary Committee on Industry and Commerce.
Sure.
Right. And Anthony Mandiwanza, they're giving us a speech that does, of course, spell out issues that need to be addressed in as far as the dairy market of Zimbabwe is concerned. What are your thoughts in as far as that is concerned?
His concerns are real. When you mentioned the issue to do with milk supply, okay, on the outset, we are demanding more than what we are supplying.
Right.
But in terms of the supply, there's a difference between milk supply for the producer and milk supply for the final user.
Okay.
So milk supply in the context of a producer, which he is as Dairy Board, meant intake of milk from the farmers.
Okay.
So the numbers that he gave were a highlight of the deficiency in terms of what the industry demands, but as a derivation of what the final consumer also demands.
Thank you for the
So
clarity
he's
there.
saying the intake is lower than what we demand as industry.
Right.
In turn, which is what can satisfy what the consumers also want. But he also hastened to point out that we have the capacity to process. So once you take in milk, you process. And when you process, you can use it for various, whether it's yogurts, whether it's fresh milk or whatever it is.
Okay.
But what he was trying to highlight is that there has to be a revival in terms of the national head. Once you improve on your national head, then you are likely to improve in terms of your milk supply. Because when farmers have got more head, they're likely to produce more milk, and they're likely to deliver more milk to the processors, and the processors can be able to then supply. But what happens in the absence of all this? Zimbabwe has to fork out money to import. And what do you import? You import powdered milk and other and other additionals that are needed in the produce of all the bouquet of products that are on the dairy side. So what he was simply saying was there is a cost attached to failing to improve our national head.
Okay.
But who has got the mandate to improve on the national head? So he was saying government really has got this obligation to push for such a long-term industry demands.
Government has an obligation. What could government possibly do in as far as heeding that call? I think that's a bold call by Mandiwanza. What could government do to heed the call?
They simply have to finance such activities. Why? Because you have a ready taker, and what you now need is the produce. So if you have a ready taker, you need the produce, but you need the produce at the right price. So they have to ensure that they fund farmers.
So
whereas you are improving on land in terms of irrigation, whereas you are improving on any other things to do with the land, you might also need to look at how to increase the kind of head that farmers
command dairy.
It might not necessarily be a subsidized exercise, because you have to finally pay back in a way.
Maybe bring in private players.
Yeah, so you can. There is a room for private players to play, but there's also part of what the government can do in terms of financing that. There can be a financing model which allows for repayment, but all the same, whenever you look at these issues, it's always a function of a cost-benefit analysis. When you look at wheat or when you look at soybean, that's the same problems that we are facing. Are we able to improve our national produce in terms of crop A and B? And if we are to say farmers are doing that, at what price can we take their produce? And how does that price compare to the regional prices?
Right.
Is there parity of prices? So at the end, you find that we end up paying more than what we should, because our farmers may not be as productive enough. So we have to address the issue of productivity across all the crops and all these other farming activities, so that we can be able to beat the parity price. Because if we don't beat the parity price, it means we are paying a premium and someone has to subsidize. Because at the end, you won't be selling for that much, you'll be selling for less. So I think it all speaks to an inefficient agricultural sector.
Right.
And it's rampant, it's actually visible as well in his sector. So he's worried. Why? Because he has to fork out Forex. And Forex has not been forthcoming. If Forex has not been forthcoming, what then happens? You mothball Bulawayo, you mothball Koke, you mothball Guero, and you are left with Chipinge and Mutare. And all those, in fact, the Mutare one operates at about 40% capacity. The difference is now being used for other dairy products. And only Chipinge is quite viable, but still below capacity. But all that is a function. This is an investment that has been paid for. And now they're not able to produce to capacity, and it ends up being a cost to the company. And that's true for many companies.
Progressing. RBZ has just released a report for the month of November. I think there's something worth taking a look at. Our money supply was beginning to decline, but all of a sudden we have a slight growth of just 0.27% in the month of November. Why is that, and what does this indicate? Doesn't sound good to me.
Yeah, I wouldn't know why money supply has to go up, but what I know is that the government's aim lately has been that we should reduce money supply. So the significance of the November outturn is that over the past 10 months before November, which is up to October, we realized a growth, in fact, up to September, and a decline in October. Why do we yearn for a decline as an economy? Money supply is a function of credit growth. When credit is growing in an economy, then you are likely to have money supply growing. Year on year, as at October, was sitting at 30%, which means from the 2017 level, October, up to 2018, money supply grew by 30%. That's a very huge growth in a single year. it can only be justified if you are able to increase your productive base by a similar margin.
Okay.
Alas, we grew our economy by less than 5% in 2018. So if you are speeding at if you are driving money growth at a speed of 30% and you are growing your productive base at a base of 5%, there is a mismatch. Production and actual money will always there is that lag.
Okay.
So people have more money because money supply has gone up, but there is less goods. So what happens? There is pressure on goods. Prices start to rise. But is that the only causative? No. There is also a mismatch between that money, which is growing, against real money in the economy, which is USD, whereas demand still remains high because money supply is high. So what ends up happening is that there is a clear pressure for prices to increase.
Okay.
This is why we have seen prices going up over the past years.
Right.
What again do we see from a growth position? A growth position is also an indication that there might have been increased borrowings, because the only thing that increases money supply is interest. Where is that interest coming from? Interest only comes when you issue debt, a debt security. And when you issue a debt security, it accumulates interest. And when that interest is added to the principal, we come up with the net money supply. So there is a growth. So it's worrying to see money supply growing at a point where we said government is no longer resorting to borrowing from the private sector. Government has been doing so over the past 3 years. And the net result is that there is a deep cash crisis in the economy. Government has allowed its borrowings to go at a very sharp rate to finance some of its activities and a budgetary shortfall. So in November, we saw a marginal growth, but it also shows you that our problems are not yet over. We are still in it, and there is still pressure, growth pressure, although the month-on-month rate is coming. In fact, the year-on-year growth rate is coming down, which is shown here in orange. So the year-on-year rate is slowing down. Why? Because the base from the same period last year was now also beginning to increase. So if you're coming from a base which is quite higher to also a similarly higher level, there's obviously that less growth level in terms of money supply.
My question then is, with a monetary policy statement due to be released, if you were in the shoes of Dr. Mangunjga, what strategies would you put in place going forward?
I think as Zimbabweans, we have a tendency to complicate our crisis. I believe we are a very small economy, $25 billion economy. What needs to be done is fiscal consolidation, of course, as a base. But I don't believe in consolidating the fiscus without consolidating the monetary front of the economy as well.
Right.
So what should be done now? We definitely need the fiscus, the monetary leg. How can that be done? There is need for us to go back at least to a partial dollarized economy.
Okay.
Or if we are not going back to a dollarized economy, then we have to resort to our currency but with pegs.
Okay.
How would that help? Because already we are existing in an economy with ready pegs.
Right. Once
you liberalize partially, you improve the rate at which money circulates. Because as I was saying, is at 1:1, I as a miner, I'm not willing to give you money. If you liberalize the rate, then I'm likely to be enticed. It might not be as fairly as what the other market forces would demand, but it will be quite rational for me to release at slightly a higher level. So what then happens is you start to realize growth in the productive base. And there's also an appreciation in the economy that if you totally liberalize the exchange rate, then savings will be lost overnight. There will be a serious massacre in terms of companies failing to repay their dues,
Pensions.
and so forth. So a lot of companies will crumble, even some listed companies might even crumble overnight. So there's need to manage. So in terms, there is need for balancing. There is a what we call populist moves. Similar in Nigeria, the person who is competing against the incumbent is saying, once I come into power, which is just in 2 weeks' time, if I win the election, I'm definitely going to do away with the current regime, which is a managed exchange rate, where they floated it a bit and they definitely manage it, but it's not purely market forces. Those are populist measures. Once you get in power, you start to realize the full impact of playing such a hard ball. But what I believe Mangudya has to do is to actually realize that the bond note is not working, money supply is up, there is need to liberalize the exchange rate to a certain level, and there is need to go back to a dollarized economy, of course, coexisting with the local currency. So what has to be done, of course, is to introduce a currency, but then it's
suppose we introduce a currency and then we allow it to float. That would be bad news.
Yeah, but then you cannot float an exchange rate if you don't have an exchange rate, because for an exchange rate to exist, there have to be two currencies. So if you are to say we have to float something, then there has to be a currency. So for Zimbabwe to have a currency, we should introduce a currency and we should forfeit the bond note.
Right.
But all the same, do we have the kind of confidence that can support currency stability? We don't have such confidence. This is where government comes in to manage, because we already know that once a new currency is introduced, without measures to protect it, definitely it will crash. Either way, it's headed for crashing if, in fact, even if we introduce a new currency and we manage it gradually, if the economy, if we are not improving our fundamentals at the same time, it means it's headed for a crash. But I would believe that in a period of 12 months, with a weaker currency, with a managed currency, the fiscal side is expected to firm. It can firm. Why? Because produce will be going up. At the present moment, those gold statistics show us that if we don't change the currency regime, then production is likely to go up. But if you relax the regime, then production will go up. And this production is what earns us money. It's also what improves our GDP position. So on the net, there is need for enticing those who are producing. And those who are producing are against the 1:1 exchange rate. And if they are against it, means it kills the production. So there's need for enticing, but there's need for protection on the other end. So there has to be a balanced act. You cannot keep on sustaining the 1:1 line. Why? Because the productive base is going down. But at the same time, you need to protect this money, which you told people is real money. So there has to be a balance. So once you put in a bit of an exchange rate, but not a 1:1 exchange rate, by introducing a new currency.
Where would you peg it?
I wouldn't know where. That would be really. I would need to do a homework on that. But I would prefer such a model as a temporary model. And if we are sincere in terms of managing our fiscus, which I don't believe Mtuli is anyway, because when you look at our level of expenditure, I don't believe that is sustainable. I don't believe we can be able to repay our debt. We can be able to invest in capital projects at the similar spend level which he has prescribed for 2019. So suppose the fiscus leg was moving in the right direction. We would need just 12 months with this pegged rate, but rather not a 1:1 rate. A partially floated rate, which will allow for enticement on the productive sector and allow for free movement of money and inputs. But now without that, industry will go down. And when industry goes down, even your fiscus leg will also go down, and there's a sustained crisis. So something has to give in. There have to be a liberalization, but not a hard landing. Because the hard landing will also force those companies to shut down right away.
Okay.
So there has to be a balance. But I believe the currency might be coming, and it might not be desirable. I don't want it, but I believe there has to be a balance in terms of what the governor brings on board.
Well, that's it for tonight. Respect. Thank you for those insights. Thank you, Zimbabwe, for watching. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our informative website, www.equityaccess.net. From Respect and I, Danke and adios.